Well, good afternoon, and thank you, Cynthia, for preparing such a wonderful agenda. I have to say, the morning presenters have set a very high bar for us. We've had a lot of forthright, instructive speaking here, and I'm counting on this panel to be as blunt as some of the morning speakers have been, so I'm really looking forward to it. My name, as Cynthia has said, is Julie Desjardins. But more importantly, let me introduce our panelists to you. To my far right is Gigi Dawe. She's going to be representing the director point of view on this panel. Next to her is Sarah Keyes, who has the enviable job of representing the accounting point of view on this panel. And Catherine Jackson, to my immediate right, is not going to get off lightly because she's going to represent the investor viewpoint. Now, Catherine has worked both internationally and in Canada, so hopefully we'll bring a bit of both of those perspectives. I hope that during our panel, we'll be able to address some of the issues that came up. I may raise them myself. If not, please follow through and ask us questions. How this panel is going to operate is we have no PowerPoints. So how good this panel is will be somewhat dependent upon how good you are in putting us on the spot. So what we plan to do is each of the panelists will take a few minutes at the beginning to offer a point of view. And then I do have a few prepared questions that hopefully will elicit some information that might get you thinking about things. But at any time, if you have a question, raise your hand and we'll be more than happy to address it. Okay, I'd like to start with Sarah Keyes. Sarah is going to start us off with just taking maybe a moment to do something we didn't necessarily hear this morning and talking about why this matter is urgent. I'm somewhat hesitant to say, but she is a millennial, and I think the only one so far, but she's here because of her expertise. And as far as talking about millennials, I am not going to mention the rest of these panelists.
I'm not far off.
Now, I think we better challenge some of the statements up here. Okay, over to you, Sarah. Why should we care about this, and why is this urgent?
Okay, so it may seem strange to hear from the accountant as to why this is urgent, because I caught the last tail end of the presentation before lunch, and I know that the accounting firms as well as the profession have their work cut out for them. So the good news is that I actually work for the Canadian accounting profession, and I'm pushing this issue a lot internally. The even better news is that we actually have the support of the CEO to start investigating these issues, making sure that accountants are engaged. So one of the big things in terms of context setting is, why is this urgent? What are the timelines? So I'll talk a little bit about the basic science. We had the privilege of actually listening to Christiana Figueres, who's the former executive secretary of the UNFCCC, and really the key negotiator in the Paris Agreement. So we got to hear her speak last week, and I just want to echo one of her analogies. I won't claim it as my own. So when she was explaining the urgency, she really talked about thinking of a bathtub filling up. And the bathtub is about 2/3 full, which means, in climate terms, we've emitted about 1,200 gigatons into the atmosphere. Now, there's really a finite amount of gigatons of greenhouse gas emissions that we can emit, so we have about 1/3 left for the rest of time. The real question that came up after the session was, what happens if the bathtub overflows? And I wanted to kind of make that point today, because I think right now we're on track to hit a 4 to 6 degree world in terms of global warming beyond pre-industrial temperatures. So the concern with that is that a 4-degree world has been stated as uninsurable. Not for an individual company. The entire insurance sector cannot exist. It is no longer economic. They won't be able to manage the liabilities associated with the extreme weather events that will ensue. And this was actually a statement by the CEO and chairman of AXA, which is one of the largest insurers in the world. And really, that's the aspiration of the Paris Agreement. It's recognition that the science says that if the bathtub fills up to the top, that's 2 degrees. If we go beyond that, that's the catastrophic tipping point that we're not going to be able to manage those risks. So if you really think about that, we have 600 gigatons left, that 1/3 of the bathtub. and we're emitting about 40 gigatons annually. So if you do the math, that gives us 15 years to get down to 0 emissions before we exceed that 2 degree. What's quite concerning about that is how quickly do we want to get there? So Christiana is actually heading up something called Mission 2020, which is the recognition that either we can keep pumping along as we are and then hit a cliff and we're going to go straight down, which would not be good for economic and financial markets, or we can peak within the next 3 years and aim toward a more smooth transition. And really, I think the interesting piece there is that there's a huge opportunity associated with this transition. I think we don't talk about it enough. So I really wanted to just emphasize there's really an urgency to this issue. We really need to cap our emissions within the next 3 years. So the Paris Agreement seeking to limit it to 2 degrees. I think one thing really important to note is that we have already caused 1 degree of warming on average. And the interesting thing for Canada and in our context is that because of our geographical positioning, we're actually experiencing double the global warming that the rest of the world is. So even if we cap it at 2 degrees, Canada will experience likely 4 degrees. So this is really important for us as a global player. You often hear, Canada is only representative of approximately 1.6% of global emissions. Why should we care? Well, certainly we should care on a global scale because we're going to have a huge challenge in terms of adapting to the impacts of climate change. So with that context, I just wanted to highlight that really, climate risk is both systemic and systematic. It's systematic in that investors can't diversify away from this risk, but it's also systemic in that it's got a source of contagion right across the markets. So I know there was some conversation about SASB this morning, so I've heard, and they've done some research to indicate that 93% of U.S. equities are impacted materially by climate risk. So I think this is really significant and something that, of course, boards of directors need to be looking at. 2 key areas of risk that I'm sure have been discussed in the context of TCFD in the earlier sessions. Really, we're talking about transition risk, which is really focused on mitigation. So how do we get to this lower carbon economy? Everything from coal phase-outs to energy efficiency to carbon pricing. These are all key factors for business that are really going to hit the bottom line sooner or later. On the other side, there's physical risks, and that's really the adaptation component. And I always, when I'm talking about this, it's really not one or the other. I think a lot of the conversation does focus on mitigation and emissions, but also Canada, as I said, is really a country that needs to adapt. And we're also looking, we're going to have to invest a lot in infrastructure in the coming years. And really an important part of that is the long lifespan that infrastructure investments have, in many cases up to 30, 40 years. So certainly looking in that long tail, adaptation is equally as important as mitigation. So with that context, I think I'll leave it there.
Okay, thanks, Sarah. So when one talks about climate change, this is not an issue that's out there 50 years from now. If you really pay attention to the science, this is an issue now. And what Sarah Barker said this morning many times certainly starts to make a lot more sense in that context. Catherine, let's hear what investors are doing on this issue globally and in Canada.
Okay, I wanted to give a bit of a global snapshot because I think in Canada we're a little bit insulated. We've come through the financial crisis really well, and our pension funds are, on a global scale, very, very well funded. Some of them are overfunded, some of them aren't, but overall it's Canada and the Netherlands that kind of lead the rest of the world. So I wanted to compare and contrast what's happening in Canada versus some other markets which are really forward thinking in terms of how they're handling their response to climate change. I know you referenced the La Caisse de dépôt this morning. I wanted to just say one more thing on this, actually 2 things. One, they've come out with their strategy to adapt climate change. I don't know what it's going to mean in terms of carbon footprinting, which Judy had referenced earlier, but they are talking about over the next 3 years. You said invest $8 billion. I went back and read the press release. They actually said they're going to invest $8 billion more than their 2017 rates, which is 50% more than they have right now, which is $24 billion, which is 8% of the total assets of under management. That's going to be invested in impact investment style, which is a very large number for a Canadian fund. When I was doing some research more recently, I found that BCIMC has an impact fund that's valued at $1 billion, and I don't know of any other Canadian fund that has anything near that size. So this is very, very big news in both the Canadian but North American context as well. I really like the fact that they said they wanted to accelerate the shift to a low-carbon economy, and that is exactly what our fund should be thinking about doing. So I won't get into the metrics of what they're thinking about doing. I wanted to talk a little bit about some of the other funds. New Zealand, which they compared themselves to in one of the press releases, maybe perhaps a reporter did. Very small fund, 32 billion Canadian dollars of assets under management. Their board is driving the change on climate. So they have this throughout their entire investment framework. In fact, their investment belief on climate change is, and I'm going to quote, climate change risk requires an investment response supported by our investment framework rather than an ethical policy decision. This is not about ethics. This is about dollars and cents. It's about returns. So whereas the cases said they want to go down 25% in their carbon emissions by 2025, New Zealand Super has said that they want to go down 20% by 2020, and they want to have their carbon reserve intensity reduced by 50%. They have already moved a number of their investments, representing 40% of their overall fund, into low carbon investments. That's also really significant as a measure. One of the really interesting things they did say is they acknowledged, look, we're going to be invested in high carbon emitters. We are, but we're going to pick the best of a bad lot. So we're going to look at which managements manage these most effectively, and how are they integrating climate change into their business model. And we will invest in those. And those that aren't talking about it at all, forget it, we're divesting of them. I think that's a really important thing. The other thing that I really like about New Zealand Super is they are expecting these high carbon emitters to earn a higher rate of return than the low carbon emitters they're investing in. So they're trying to internalize some of those external costs in terms of rates of return. PGGM is a Dutch pension fund I worked for a number of years until recently. They have about 288 billion Canadian dollars of assets under management. They are one of the most active responsible investors in the world. And they had in 2015 said they were going to have their carbon footprint by 2020 and quadruple their impact investments to 20 billion euro. So those are some, and by the way, PGGM is a smaller fund. There's a larger sister fund in the Netherlands, and they're committing 58 billion euro to an impact fund, which is about 80 billion Canadian dollars. That's the scale of impact that they're investing in. They've already divested of some oil and gas companies, and I think it's really quite interesting. They're also not just looking at low carbon. They have picked their solutions that they're investing in, including water scarcity is one of their top 4. Access to medicines and healthcare is another one. The largest pension fund in the world resides in Japan. They have 1.6 trillion Canadian dollars of assets under management. They set up their ESG stewardship team in October 2016. And they have picked climate change as the topic. They've looked around at what's going on in the world, and this is the one thing they've decided to focus on. And in July of this year, they said they're moving 10% of their assets into ESG-specific investments, up from 3%. To give you a sense of scale, that's $160 billion. Ontario Teachers' total pension fund is 178 billion Canadian dollars. So they are going to move a massive amount of capital into impact-style investments. They are passively managed, so this is going to be interesting as to how they actually do this, but they're making big moves, and they're doing this at a rate far faster. They haven't had an ESG team for, well, it's October now. They've had them for a year, and these are the steps that they're taking. I worked at the Ontario Teachers team in 2004. I mean, where's some of the news happening here? So I'm trying to show that there's a bit of disparity here. Norges Bank is the world's second largest pension fund. They have 1.2 trillion Canadian dollars of assets under management. They deploy exclusions. They've divested of all assets in which thermal coal is a significant part of the company's business. They did this last year. They have a definition around significant part, 30% of revenues coming from thermal coal, or 30% or more of their activities. Interestingly, as an example, they divested of Barrick Gold in 2008. And the reason they divested of Barrick Gold was because the company presented an unacceptable risk to their fund in terms of contributing to serious environmental damage. Very interesting. We've talked a little bit about the global asset managers. We heard about them this morning. Yes, they've all doubled their stewardship teams or increased them significantly. Yes, BlackRock and some of the others have started voting in favor of shareholder resolutions to do with climate change. This is important. It has caused them to go to majority vote support, like Exxon and Occidental. BlackRock themselves were recipients of shareholder resolutions on their voting. So this is very important. This is what's moving these asset managers, is both their clients and their investors. So as a former client of BlackRock, asked a lot of questions. Why are you saying this publicly but not voting and supporting these resolutions? There's a complete disconnect, and it was to me, it was quite disingenuous. Now the rubber's hitting the road because they've been receiving these resolutions for a long time, and thank goodness they're moving. This is all really good. In Canada, I think there's a little less of movement of capital, a lot more focus on engagement. And I think one of the things we need to think about as Canadians, and particularly as all of us are beneficiaries of some pension fund or another, what does that mean and how effective is that? What kind of changes are they implementing here? We need to know about this to assess the effectiveness of the programs. I want to skip ahead a little bit. The other thing I think is we should be asking for is whether or not they have sustainable investment targets. They are putting out sustainable reports about their activities, so their sustainability reports, just like companies have put out CSR reports. And they're very fond of, as a general group, talking about 1 or 2 or 3 investments that they've made, but these for sure represent 0.000 something% of their total assets under management. I think we need to see something, if we're going to move our market forward into more like investing in some of our infrastructure that we need, or whatever it is, moving to a low carbon economy, we need to see bigger numbers going in. Divestment is not something that Canadians are fond of doing. CPP has said that they have a legislated investment-only mandate, and that's where they're hanging their hat. I think that's really interesting. I don't know why that means they can't not invest in certain companies. I'm sure as part of their active stock-picking team, they are making those decisions, but that's just not something that they're actually stating actively on their website. One other, perhaps, and I don't know why this isn't an issue for other funds and other markets that have managed to make investments or divestments, but one of the really interesting things is that's held Canadians back, and I have this anecdote I want to share, is that we have the compensation plans are sort of 4 or 5 year rolling average comp plans, and in years gone by, there were great investments that came forward that would have been terrific in terms of moving climate change initiatives forward, or they were great infrastructure type investments, but they had a long runway to profitability. So clearly more than the 5-year limit. In one case, I was told it was 10 years. And because of the limitations around compensation, those investment managers didn't want to make that investment. So that's a limiting factor, and maybe something we need to think about. And this whole idea of La Caisse allocating a carbon budget to their investment teams is something that I think we need to be thinking about as a real possible solution to the lack of making these investments. So whatever it is that's holding them back, I think that's maybe one of the solutions we could be considering. And I just wanted to stop there.
Well, Catherine, I don't know about the audience, but you've raised a few questions in my mind that I'd just throw out there at this point. First of all, I'm not at all surprised that it's from Quebec, the Caisse, that's leading things here in Canada, and maybe that's something we ought to be thinking about. Why is that? Is there something different about Quebec that makes them a little more homogeneous in getting onto this? That they get this issue of climate change and they're prepared to ask the questions? Another thing that struck me as I was listening to you is sometimes when you talk to investor relations people and you ask them, why do you not have more disclosures about climate change? They'll say, well, our investors aren't asking for this information. And in turn, what I heard you say is, well, nobody's asking some of these people, what are you doing with my money? So maybe there's some thoughts there. As far as divestment in fossil fuels here in Canada, the only thing I've heard a bit is the churches are getting active in this. And as you know, the churches were the instigators for the movement against apartheid. And so some of the Canadian churches are quite interested in divestment. Having said that, divestment is just one small part about transitioning to a low-carbon economy. And so what? You divest. Have you really solved the problem? So thank you, Catherine. We'll get back to this. Gigi, directors.
Okay. Thank you. I'm just going to speak a bit about the role of directors or boards in climate change, but more specifically, how can we, as the people in this room, investors, lawyers, engineers, accountants, and other business people, help boards to do, as Jane Ambassador said, to be prepared and to influence a two-degree scenario. I believe boards are starting to consider climate change. I think a variety of factors, including investor pressure and fear of litigation, is beginning to change the conversations in the boardroom from whether there's an obligation or a mandate to engage around climate issues to how the company should best incorporate and address them. So we're starting to move, but I do believe they're still just conversations. Boards are responsible to guide and support the long-term thinking and planning by management. They bring a broad external view to the company, and they're there for a longer time period. So if you look at, in Canada, the average CEO tenure is about 3 years at this stage. The average director tenure is 11 years. They should essentially have more skin in the game by the fact that they are more involved for a longer period of time in terms of what's happening around this and understanding the benefits of dealing with climate change for themselves, if not the company. However, I think to follow through on this, boards need to be climate competent. Problem is, they also need to be compliance competent and strategy competent, and they need to be integrated reporting and TCFD competent, and cybersecurity and technology competent, and finance and risk competent, and definitely compensation competent. Now, I'm being a bit facetious about this, but I realize that boards are made up of groups of individuals, but I do believe we're expecting a tremendous amount from our directors. We're expecting boards, many of whom did not operate a business through any of these types of issues, to be able to anticipate and proactively respond to complex climate risks. Sarah earlier used a comment that I thought was interesting: bring your own crusty old audit partner, to something she was referring to. And you know, when I look at boards, and I hope there are none in the room now that I'm going to say this, really crusty old board members is what we have to deal with. That's our reality, and that's you know, one of the challenges that we're going to have to deal with. We've got a world that's flying at 1,000 miles per hour, and we expect those who operated in a completely different environment to just get past the noise and start to take action. So we've really got to look at what can we do to help in this situation. It's easy to criticize boards in response to climate change, and I believe to an extent we are justified in doing this in terms of some of the disclosures that we're seeing come out and their responsibility for disclosures. However, I believe disclosure is just one part of it. I believe boards need to understand and help the organization to actually have something to disclose. Part of it is disclosing the risks that they're currently exposed to, but part of it is also really taking a look at what is the organization doing. I also believe companies have not yet established corporate governance structures or processes to support climate change issues. So what I think we're still in is, in good faith and with great intention, boards are taking incremental approach to tackle these very complex risks. An incremental approach is not going to deal with the urgency that we've talked about earlier. I don't believe the majority of directors are even aware of the issues associated with climate change, and they definitely are not aware of the urgency that Sarah mentioned. The KPMG study that a couple of people have referred to earlier, amongst other studies, indicate that I don't think climate change is even making it onto the board's agenda. I'm also not convinced that directors even know what they don't know about climate risks. But I do believe they're not alone in that. There are very few climate competent people out there. And I think that's the first thing we need to acknowledge. We're sitting in a room now where we're preaching to the converted. I don't think there are a lot of people that do understand these issues, and that certainly who understand these issues in terms of what a role of a board would be. So there are a lot of people talking as though they're competent, but I'm not sure everybody is. So we talk about climate competent boards, but where are they going to get these climate competent members is an issue in itself. I'm not even going to get into what we can do. I'm going to wait till we get to some questions. What I will say is I do believe that if boards knew what to do, they would do the right thing, and that we as professionals should not be getting in the way. And I'm just going to give one anecdotal example of this. CPA Canada for a number of years has been providing guidance to boards of directors. And I've seen, as time has gone on, much more interest in their picking up the stuff we're doing and trying to do something with it. However, it's guidance. It simply is, are there booklets to give ideas for boards to think about? And I think that that's not enough of what we need to do. But one of the things we did, I guess about 3 or 4 years ago, was put out a very prescriptive piece on the oversight of risk. And it really is a step-by-step guide for boards, and quite strongly presented in terms of what boards need to do. The response we got from boards was, this is one of the best things we've ever seen. We really did struggle, and we do struggle with how to deal with risk. And this is actually a great piece to help us with this. And we ended up working with the ICD, who's doing a one-day course on it to try to keep this going forward. So they definitely saw this as something helpful. Who went absolutely ballistic about the fact that we put this piece out and criticized us and criticized the piece? Risk managers. How dare you suggest that boards are responsible for this? How dare you take what we're supposed to do and pass it on to boards? And I think we all have to be aware of, are we expecting something of boards and then not really helping them to get there, or seeing it as our role, or getting threatened by things that they're doing? These are considerations I believe we all need to make. I'll leave it there.
So Gigi, what I've heard you say is at best it's steady as she goes at the director level, at best. And maybe they're not even engaged in this. Well, I guess that's one of the, 2 thoughts come to me. I guess that's one of the advantages of having a day like this, where we talk about their legal liability. Now, I just have to, from sitting in the back this morning, make a comment about the practicality. I don't think we're going to see Oslers or Gowlings or Tories or any of the large firms here in Toronto taking on these cases. And this is my personal opinion, but they're all going to be conflicted out because they're either going to have, you know, clients, or they're going to have their own people on boards, or they don't want to miss out on future business. So who's going to take these lawsuits? Maybe what you're looking at is a one-man show that does some of these class actions. I don't know, but that's going to be a challenge. So when we're talking about this, we have to be realistic about the market we're in. Secondly,
Can I just respond a bit to that? One of the things, looking at the other side of that as well, is you are seeing litigation, and I think certainly Cynthia had raised some of it in the brochure for this conference. And I was at an event, very small, like just 8 people, I guess about 2 or 3 years ago, where there's a lawyer in the US, and I'm sorry, I don't remember his name, that's taking some of this on in terms of class action suits. I believe we also have to consider the unintended consequences of this. When we litigate and when we pressure boards and companies to do some of this stuff, we are in fact decreasing the urgency. We're forcing them to get caught up in dealing with this litigation. And yeah, there's a very clear message that you need to be more involved in this, you need to work more around this. But we also, if there's an urgency factor here, we have to look at litigation and look at some of these issues, but also look at how do we help them to get through this and be more effective.
Okay, we got some questions going here, please.
So I'm not going to ask about litigation.
Yeah.
Just a minute, can I just wait while we've got the...
Sorry, I'm not going to ask about litigation, and maybe we could talk about that afterwards. But I'm really interested in the idea of having climate experts on boards. And what does that mean? So we know Exxon Resolution got one on board this year. I think it's Susan Avery. Mm-hmm. What do you think? How does that help with board education? Is it significant or is it symbolic?
What's that for me?
Well, I think any one of us that's opinionated on this, I have an opinion on it.
Yeah.
Needless to say, I have an opinion on it.
I actually want to provide some context here, Julie. So we recently did a study, CPA Canada and Financial Executives International, the Canadian chapter. Their FEI Canada's membership is really the CFOs, as well as many of them are also corporate directors who are at small, medium enterprises right across the country, and they span a whole bunch of sectors, but a lot of them are in the heavy emitting sectors, so presumably on the front lines of this issue. When we did this survey, we found that 60% of corporate boards do not consider climate change at all, and only 20% do. And then the other 20% were completely unsure as to whether or not it was even on the board agenda, which probably suggests that it is not, if they're not getting asked those questions. So just from a level setting perspective, I think there's a ton of work to do in this space.
Yeah, and I agree with you, particularly, and that reflects many of the smaller to mid-sized companies in Canada. I think there's a huge issue. Dealing with the expertise on the board, I do believe boards need to start recruiting climate change experts onto the board. And, I looked at, there's a couple of examples. ExxonMobil has just brought someone on. ConocoPhillips brought on Jody Phillips to the board. General Motors brought in John Ashton. So some of these companies are doing it. But I'm not talking about some of Canada's small to mid-sized boards here. And it is a bigger challenge to bring good directors on, particularly those with climate expertise. One of the things I think boards need to start doing is open their minds about who can be on their board. So we look at millennials. There are, that's where you are going to get more of this climate change expertise. So perhaps more openness to bringing a millennial on the board. Now, we've got to keep in mind, those millennials that are brought on board can't just bring one thing to the table. They have to be able to be competent in the core board functions, strategy oversight, oversight of the CEO, compliance, a variety of areas like this. I do believe there are millennials out there who do bring that to the table, and I think there needs to be more openness at this stage to who they're willing to bring on the board. The other is if they're not going to bring or not able to bring people onto the board because they don't bring the variety of expertise, there's certainly a lot of people out there that they can bring on as advisors to the board, and they can accept and be open to more advice.
Just one last comment on this point. In my mind, a client-competent board is not one individual that has some scientific background. A client-competent board is a board that understands strategic risk management, the rest of it, that factors climate change and the huge systemic issues involved in that into the board decision-making in general. So one person with a scientific background wouldn't cut it for me.
And I know there is movement afoot at the World Economic Forum and some other organizations that are starting to, with some pushing from, interestingly, some European board members who are trying to mobilize some education efforts. Again, I don't know if there's anyone from the ICD here. I'm going to go with no. And not for lack of trying on the organizers' parts, but they should be here. This is exactly what their membership needs to hear. So I don't know what that's all about. I'm just going to call it out. But, so there are organization here for helping to educate board members, and we really need to have some of those people attending events like this on a regular basis.
Now, Sarah, we heard at the end of the session before lunch that accountants have a huge role to play in this. And I realize you represent the accounting profession, so some of us independents may come along and put a little bit of color to it. But maybe you could talk just a little bit about what the accounting profession really has been trying to do in certain areas.
Sure. So I think it often comes as a bit of a surprise to folks that there are 210,000 accountants in Canada. We actually have some of the most accountants per capita in the world, and we're actually the third largest accounting body globally. So we've got a lot of influence. Hard to find an organization that doesn't have a CPA in it, which means that it gives us an opportunity to have a real impact by getting CPAs to start asking questions about this. We often hear about the disconnect, and to the point of the panel prior to lunch, it's, you've got the sustainability professionals not talking to the finance group. And ultimately, when we talk about the urgency of this transition, a huge component of it is not whether existing technologies can help us to do it. We know that they can. It's financing them, and it's making better investment decisions. So I guess some of the things we've been doing at CPA Canada in particular, about 60% of our members work in business and industry, again, providing a huge opportunity for impact. These are the folks who are doing a lot of financial statement preparation. They're also preparing reports to the board. So there's kind of the element of external reporting that's going to be used by investors and other stakeholders, as well as that internal reporting for decision making, which I would argue is equally, if not more, important in terms of how the company is actually making decisions. So we've been really focused on trying to help accountants to wrap their minds around this. Won't be shy to say that it is sometimes a challenge. We are a profession where people tend to view themselves a little bit more narrowly than we think their capabilities are, possible for. So one of the big areas we've been looking at is disclosure, because one of the challenges when we think about the TCFD is that's really going to have to come from the chief accountant in these organizations. The controllers are going to need to be engaged in the conversation, and even perhaps more importantly, so will the CFO. So one of the things that CPA Canada has done this year is actually launching with the Prince of Wales charity out of the UK, the Canadian chapter of the Accounting for Sustainability Network. And really what we're trying to do is engage that finance function to not be so shy and to go and talk to some of their sustainability professionals, but also make sure that they're well equipped for when they get tapped on the shoulder about questions on TCFD and climate disclosure, as well as hopefully after events like these, questions from their board.
So in about 2000, we've got two questions out here, but I just want to ask the panel one before. In 2008, 2009, CPA Canada has done some great thought leadership in climate change. They've been first in the world in some of this. They put out their first edition of the questions for directors to ask about climate change. They just recently, this year, put out a second edition of it. But, if you talk to the firms, some of their risk areas will deal with this, but there's no money to be made in this area, basically. And it's not getting through to the audit side of things. So, I'm going to throw that back to you guys and say, what do we need to do to reach the audit firms? Because they are critical on any execution of this stuff. So just one question. Well, Lynn, you've had your question for a minute. Lynn, you have a question?
Well, it's a bit of a lead, but one of the things that I've heard a lot this morning is about the concern and the blame and the risk. We don't actually have time to waste blaming people. We really don't. The other thing is, on that note, we've spent a lot of time talking about the negative side. There is a huge opportunity in this side that we really haven't touched upon today at all. If you look at the field of biomimicry, which is the art and science of the technology of biology, it is a huge growth area. They're looking by 2025, which is not that far away. You're talking about a $300 billion opportunity. Why aren't we investing in these things, as opposed to spending our time whining about the fact that we haven't got decision makers who are making good decisions? We just don't have time for blame. I do think there's a big role for the accounting profession, especially in the area of small business. And I think the opportunity is not to put the pressure on the accounting bodies or accountants to try to be superheroes. I think their opportunity is to be everyday heroes, where they normalize sustainability activities from the reality of, if you do not have air to breathe, you've got 3 minutes. If you do not have water to drink, you have 3 days. Day 3 is not a lot of fun. You have 3 weeks before your food supply is gone. So the comment that Sarah made this morning about 1.5 billion migrants ain't going to be the problem. The problem is going to be dealing with the cholera and the disposal of the bodies after the 3 weeks. So let's get the universities who need to train themselves on sustainability first, who need to mirror their talks about sustainability reporting with doing it. And then we all need to do something individually ourselves to push that envelope.
Why aren't investors investing in this stuff?
So, my comments earlier were just really focused around the pension funds in Canada, because that's what I know the best. But, and one of the problems around the pension funds is it's all economies of scale. So you know, they can go and with one person make $150 or $250 million investment, and that is so much more efficient for them and realize greater returns than going into some of these venture capital style really small investments that are very hands-on. And Ontario teaches is public about their very poor venture capital record. And that's why they're not pursuing some of these nascent upcoming investment opportunities, which are also very critical, which we need to make in order to transition our economy. They're all sitting there waiting for them to get of scale where they can just pile in their $500 million and be done with it. And that is a big missing piece of our puzzle here. And I don't know what the answer to that is. I'm assuming some of the banks are doing some lending. I don't really know what's happening in that space, but it's certainly in the pension fund space. I know that OMERS has started to do, they have always had a fairly active venture capital group, and they're investing in some clean tech, but.
Alan?
Is blockchain going to be a deciding factor in how investments occur in the future and leave the banks behind and the big investment? Because the investment has to occur in innovative companies, and they tend to be small business.
The question was, is blockchain going to leave the market behind and banks are going to become irrelevant and the rest of it?
I'm looking at Judy Cott. We know that the banks are looking at blockchain. I mean, how advanced are they in terms of their understanding of it? I don't know, but maybe
Yes.
Judy might want to.
Well, I can tell you, so our parent bank is definitely spending a lot of time and resources investigating blockchain, building kind of internal blockchain capabilities, as well as partnering with other banks to test blockchain for transfer payments, et cetera. I know GAM, the asset manager, is also investigating, has set up a whole separate unit to think about what blockchain might mean for asset management, different types of portfolio construction in the future, different ways of settling securities, et cetera. But I would say it's definitely very early days. And in terms of digital currency, you're seeing really marked different views about the viability. You have some people saying, you know, this is the future. Other people saying it is only a matter of time before it's shut down because of the opportunity it creates for money laundering and shadow banking, et cetera. So we're definitely spending a lot of time and resources in investigating blockchain, which I do think has the possibility, certainly, to make things easier and simpler for clients, certainly.
Just talking about the thought leadership of CPA Canada, Sarah and CPA Canada just this morning had a session on blockchain. So that's why she wasn't here this morning.
Yeah.
Alan, did you have a question?
I had a sort of question and an observation, yeah. Back, the microphone coming.
It's coming.
Thanks. Yes, back to governance basics. Catherine, you reminded us of the average tenure of CEOs, about 3 years. That made me thinking about other things that boards are supposed to do, which potentially have climate change relevance. One is, in fact, in succession planning, is selecting the CEO. So it seems to me that's part of the puzzle, is to make sure you get the right CEO, and that in turn requires a climate competent board to make that selection. And the other thing is compensation. And if long-term incentive plans only look out, I say, 3 to 5 years, and yet climate risk and strategy is kind of a little longer term than that, to what extent are there some disconnects or some silos within the boardroom in terms of succession planning and compensation? Those are observations, but you may have some further observations.
I have a lot of opinions on as I spent so many years on this topic. I mean, my personal view is that the investors have to just grab this and do it right. I think it has a lot to do with how investors evaluate and set their own compensation, and don't consider the impacts of large-scale disasters related to climate change at all when they're looking at these issues. So, I mean, I tried to come up with a solution for the Dutch fund. They're rolling it out now, but honestly, it is one of those things that has to have a long horizon, and at the moment, I don't think that anyone's doing it well at all, corporate or on the investor side. And I think part of it is our comp consultant communities just run with this. I love asking, my favorite thing is to ask people that are retired what they think the utility of their role was, and I mean, I have asked retired chairs of compensation committees in Canada that question, and their feeling is the only group that benefits from compensation consulting is management. And so really, what are we getting out of this? You know, and how's that ever going to stop? I mean, it's such a vested part of how business is done and how decisions are made and how butts get covered that I don't see it stopping. So it's just going. And the comp piece, I mean, I'm a big fan of return on invested capital myself personally, and I think we need to adjust for these big events that are just going to keep happening with greater and greater frequency.
I wanted to just mention as well about you also suggested succession was an issue. And I think boards need to absolutely consider who they are bringing in. They also need to take a really good look at who is currently at the table. If we're looking at an urgent issue, there is nothing particularly wrong with saying, is this the right CEO to bring us to where we need to go? And that you don't wait until that CEO leaves, well, you only got 3 years, but that it really is a matter sometimes of deciding this isn't the right CEO for this right now, and we need to make the change immediately and not even look at, you know, this sort of waiting for succession.
So maybe each panelist can weigh in on this in a minute. What's getting in the way of directors embedding climate change into their strategy, whether the opportunities or the risks? What's getting in the way of it? What can we do now?
So from my perspective, I think that they see it as a much longer term issue and not something that's already happening today. I think, you know, if you don't need to look much further than the headlines to see that this is already happening today. The costs of Harvey alone were in the $100 billion range. Here in Canada, the Insurance Bureau, their cost, the annual economic cost of disasters is already increasing 5-fold since the 80s. It used to be $25 billion a year in the 80s. It's $130 billion a year in the 2000s. 2016 was a record-breaking year. We saw almost $5 billion in just insured losses alone, which is a really scary thought when you think about all of the uninsured losses. And beyond that, it was just one single event that happened in 2016, which was the Fort McMurray wildfires. I think one of the things with this is that it just seems like this longer term issue that we'll get there when we need to. But I think the reality is they need to recognize this urgency of the science, as well as the fact that these extreme weather events, these 1 in 100 year storms that are happening multiple times in a decade. So I think it's the urgency.
And I say ditto to that. She said it so well. And I think what it is, it's about educating. Directors need to be educated. And I have a great example. Sarah presented to my board about 2 or 3 days ago. And one of my crusty old audit partner board members, at the end of her presentation said, you know what? I'm one of the old crusty guys who didn't get this. And if we had more people like you helping us understand, then we would be doing a lot more. And in fact, has since invited Sarah to come and speak to his board about this. I believe education is a big issue. Boards don't get it at this stage. Society doesn't get it at this stage. Let's not put it on them. There's a cajillion investors out there that don't get it. There's a cajillion auditors that don't get it. Consumers, like, we don't get it yet, and that's, education to me is a real key.
The other thing
And
I might
lawyers.
throw into the mix, there's just board culture. I mean, we've all had mothers, and somehow they could get to the grain of the truth. I mean, what the hell, right? Did you eat that chocolate bar? I mean, some of these questions can be pretty basic. So just ask. And you're all worried about it's a stupid question. Well, it's not. Because, yeah, we ate the chocolate bar. I mean, ate the box, in fact. But, but really, I mean, and truly, I think there's a cultural change that needs to happen. And some of that's going to have to be some shakeups, board composition issues. Education's a piece of it. It is a big, it's perceived as and it is, it's a big problem. But you can start with a few key questions. I have a friend who he's a CEO of a massive property company. They build homes. Sorry, not property, they build homes. And I said to him, so, you guys think about where you're building your homes and the impact of climate change? He said, nope. I thought, oh my God, and he's a CPA, CA. And I thought, oh my God, how could you not? And where's your board? But this is systemic, it's endemic, so maybe some moms on boards, I don't know.
You know what?
Grandmothers, I like the grandmothers in Switzerland, I like that.
And I just wanted to add one of the comments, Julie, you made earlier, that this isn't about getting one board member on the board. And in fact, the research has supported one board member makes a noteworthy change. One person asking the question and highlighting this to the rest of the board, it's got to be one person who's willing to ask good questions. It's got to be that mother. Did we eat the chocolate? But there's, it does make a difference. And I think there are steps like that that can be taken.
Thank you. Okay, we've got a few questions out here. Corinne?
Just a comment, Corinne Boone. I've been around this area for about 30 years, so it's kind of interesting. I'm a half glass full person, so I'm going to sort of play a little bit of devil's advocate here. Not about boards per se, but Julie and a number of us in the room, Alan and others, we were here the first time that this sort of whole climate issue exploded and then imploded. And a lot of that had to do with regulatory uncertainty in the business community not really wanting to do anything until everything was perfect. This time around, because of all the uncertainty in the U.S. and in other fora, the business community, to some extent, is actually out there saying, and there's a whole statement or a whole theme around "we mean business," and the top companies in the world are actually saying that they're doing this now and they're going to continue, and the financial community's in, and TCFD is catching on, and I'm actually working on something else right now, and a lot of the people that I'm interviewing in the survey are saying there's still so much uncertainty. What are we supposed to do? And I'm like, why don't we just do it? And I think that one of the issues right now is that there's so much momentum, but Jesus, something doesn't happen really soon that's positive. That's going to be lost again. And, that's really makes a difference. We're talking about risk all the time, and the point about opportunity is extremely valid, but that big opportunity has to be publicly discussed a lot, to get people in the swing. It's
Now,
just
Cynthia, I
positive.
know you're watching the clock. Have we got time for one more question? Or no?
Yes, I think so.
This
And then
lady-
the next panel is all about opportunity, all about what is really.
This lady right behind you.
Oh, hi. I was just wondering if anyone thought that there was an opportunity for board recruitment firms to get educated and look for people with the expertise to help put those people on the board, make the suggestion, that kind of thing.
Yes.
Okay, that's easy.
Moms on boards.
Is that a
Yeah,
chance? Moms on board.
Huge, huge opportunity.
Thank you very much. And please join me in thanking our panelists.